Hello everyone, and welcome back to Day Trading for Beginners Guide. This will be part 7. In this mini-series, it's designed for newer traders or anybody that's thinking of getting into the market. It's going to have a lot of useful information, so this way, when you get into the market, you know exactly what you're getting into, and it's going to answer tons of the questions that you might have. And it's good to do research before you commit to anything full-time, especially when it comes to trading, because there's lots of dangers out there. I know too many people that just dove into trading without doing any background research. They had no idea what they were getting into. And surely enough, the market has a special way of humbling newer traders. So hopefully you'll be much more equipped than the average person that goes into the market. So come join me for part 7, where we're going to talk about the best market conditions to trade. So we'll go over the best market conditions, and this will be part 7. And there's only 8 parts, so one more to go after this. We're going to talk about what market is the best to trade, trading with the trend, recognizing bad trading conditions, what is a good setup to trade, also entries, Confluence, and also high probability trades. So this is more going to be of a talking video, so you're not going to see me access the charts too much. I think when it comes to trading, it's just so important to get a good background of everything out there rather than just focusing on the technical analysis part. People focus on strategies. They're really driven by, hey, what strategies work? What should I be using? What are technical indicators? But there's a huge psychological aspect of trading, and that can be really detrimental to your success. So I think it's a great idea to have a broad understanding of exactly what you're getting into. And let me share with you some of my experiences that I've learned over 8 years of trading full time now. So the best market to trade would definitely be a bull market. If you asked anybody which market they would prefer to trade, a bull market or a bear market, 100% of the people would say they would rather choose a bull market. In a bull market, the prices are constantly making higher highs and also higher lows. Whereas in a bear market, the price is constantly making lower highs and also lower lows. So for example, in a bull market, a price could actually trend way more than 100%. If we take a look at the previous bull markets, we can see some coins doing thousands of percents. So for example, if you go from $1 to $2, that's a 100% move. But if you go from $1 to $10, that's a 1000% move. So you can actually make much more than double the amount of the money that you put into it when you're either day trading or investing. Whereas in a bear market, if you were to short in a bear market, let's say the price is $100. Well, if you made 100% profit on a short position, they would have to actually go down to 0. And that's not likely for the majority of coins out there. And when you're trading any coin, volatility needs to be present. Let's say you're looking at a coin that's only moving 2 to 3% and you wanted to try to profit from it, whether it's a short position or a long position. It's really difficult to profit on a coin that's barely moving and moving sideways. Whereas if there's volatility in a coin and the range is say 20% for that day where it's moved that much, you don't necessarily have to catch 100% of that 20% move, but as long as you catch a small percentage of that 20%, like even if you caught say 25% of 20% movement, well, that's 1/4. So you can still catch, for example, 5% of that 20 that moved, which is still a very significant number. Whereas if it moved say only 3%, you'd have to catch almost 100% of that move just to capitalize on it. When there's a bigger move and more volatility in the market, I find that it's more forgiving and it gives you a higher margin for error. So your entries may not need to be precise like if they were a much lower volatility coin like a 3% move. So I find that trading of volatile coins, it gives you the biggest possibility of actually making profit on that coin. Another criteria that I always make sure is present is volume. Without volume, it's just simply impossible to trade that coin. So for example, myself, I'm trading anywhere between $100,000 to $250,000 positions. Let's just say, for example, that a coin only has a $20 million volume. And if I'm trading $100,000 for my buy when I enter and $100,000 when I exit, so that's $200,000 total. If $200,000 is mine, but the coin is only being traded at $20 million per 24 hours in volume, then I'm actually 1% of the entire market. And I definitely don't want that. I want more people to be in this trade of mine as well to ensure that there's a higher demand. If you have a higher demand for a coin being traded, it's generally going to be better in your favor. Not only that, you'll have less slippage. So when you enter the market, if you want to get in at at a certain price, the slippage may prevent you from getting in at that price simply because there's no volume. The supply is going to affect it as well. So having high volume, high volatility, it's definitely going to increase the chances of you capitalizing on the coin that you're trading. I would recommend to stay away from coins being traded under $50 million of volume in 24 hours. And when I say volume, I'm referring to the dollar amount, not in the actual coin being traded. So going to some of the charts here, just for example, we can take a look back on some of my coins that I remember back in the bull market. So for example, if you see Axis during the bull market last year, you can see that Axis from 2021 here, you can see that Axis did about 3,000%. So if you had put in, for example, $1, you would have turned that into $30. Whereas right now, from the top, we see that it's only moved down about 95%. So would you rather trade a coin where you could potentially make up to 3,000% or 95%? So once again, a coin can move easily much more than 100% to double your money and more. Whereas in a bear market, when you're shorting, it's impossible to make more than 100% unless the coin went to zero, which is really rare. Not only that, in a bull market, there's going to be consistent highs that it's making, newer highs, breaking resistances. It's so bullish that I find a lot of people might even get lucky when they're entering a position. They'll just buy at any random price and they could profit from it. I'm not saying that you should do that, and I'm not saying that that's a great way to make profit from the market, but I'm saying it's obviously known to happen because it's so bullish. Whereas in the bear market, you've got to really time these entries a lot more. There's going to be miniature rallies along the way. Just for example, we look at AXS. It's dropping, but there's miniature rallies of 17%, miniature rallies of 25%, and more miniature rallies over here as well at 54%. Miniature rallies here at 67%, it's moving to the downside. And until a major trend changes, then we're going to be able to capitalize in a bull market. And the best market conditions to trade is when the EMA, of course, is trending very bullishly. For example, for a Bitcoin, you would want it to be trending over the 200 moving average, which we haven't done in such a long time. We haven't trended above the 200 moving average here for Bitcoin since around the $42,000 range. But if you look at Bitcoin during a very, very bullish year, you'll see that Bitcoin's moving average is going to trend huge. So for example, in 2021, we see that it's always trending above the 200 moving average, whereas right now we're below it entirely. And that's not really a place you want to try to focus too much on profiting in a long position. It's of course better to wait till the bull market comes, and then we'll have a higher chance of profiting in these coins that are very, very bullish. So during these bear markets, it's very important, in my opinion, to be patient, and we have to try to protect our capital, catching these trades that are falling knives or very bearish where it's still dropping to the downside. It may increase your risk of losing your capital. That's extremely important to preserve so you can make it to the bull market that, in my opinion, could be here anywhere between late 2023, but not likely, but 2024. I'm very bullish about that particular year. So hopefully we can all protect our capital and preserve it so we can grow it further in 2024. And this goes to the next topic, which is trading with the trend. The trend is your friend, and it's really important to trade with the trend. Sometimes the trend can be established on a very low time frame. So just to give you an example on Sol, if you are looking at, say, a 30-minute time frame, what you're going to see that the market was bullish and it moved 83%. So these are smaller time frame trends where, yes, you'll be able to identify these bullish trends on a small time frame so you can trade with it. But generally speaking, on the higher time frame, you're going to see a very, very bearish picture still, right? So depending on the time frame that you're looking at, it could be bullish and it could be bearish on other time frames. So trading with the trend is extremely important. For example, on Sol here, when you're seeing it move to the upside like that, it would be unwise, in my opinion, to take a short position completely against the bigger trend. Maybe on a very, very small time frame and a shorter period of time, you can gear yourself up for a short position like how I did for the past 2 days. But if you're longing it based off of the big picture, you might be in a world of hurting because we're just not quite there yet. So identifying the trend on short time frames is extremely important. For example, if you look on Sol here on the 200 moving average long term, you see it's very bearish because we're trending below it. But if you look on a low time frame, like a 1 hour, you can see that we're trending above the 200 moving average, which is the blue line over here. So depending on the time frame that you look at, once again, it could be bullish, and on other time frames, it could be bearish. So these are known as degrees of trends. We're bearish on the big picture on a larger degree, but we're bullish on the smaller picture on a smaller degree. And the next topic we'll talk about is recognizing bad trading conditions. Bad trading condition would be when a market is extremely slow and it's not volatile, and there's no volume in that coin at all, and it's completely sideways. So identifying these conditions will prevent you from making a trade. We talked earlier about how there must be volume present, there must be volatility. I'm always looking for a coin that's moving at least 10% for that day only, and at least $50 million in 24-hour volume. If you notice that it's below these criterias, it's probably not wise to take a look at them. So being able to identify bad trading conditions, it can prevent you from taking these high risk trades that may not work out in your favor. I would recommend to let the trades come to you rather than hunting for these trades that may not work out in your favor because these criteria are not met. I know a lot of traders that are new where they just have this itch to constantly make a trade every single day. They need to make money. They need to hit their profit target goal, and they're going to force themselves to take really unwise trade setups. And in turn, what ends up happening is the trade doesn't work out in their favor. It goes against them because they're forcing it, and the technical analysis or the criteria to enter just wasn't there. So I highly advise to not have that mentality of, hey, I need to make $200 today. Sometimes you're just not going to find a coin that's going to give you a good enough opportunity, that's going to be a risk to reward that's worth your time. So please stay away from bad market conditions, sideways especially. When you're in a sideways market, none of those indicators are going to help you. MACD is not going to help you. RSI is not going to help you. EMA is not going to help you. Elliott wave theory, that's not going to help you either. In these sideways markets, I personally never trade them because I'd rather let the breakout happen first. Once the breakout happens, it can correct and consolidate into perhaps a pattern, and then I have an opportunity to buy on a dip or perhaps long it on a breakout when that occurs. So the first wave is where a lot of people will not catch, but the third wave, that's where the money comes in, and that's why, based off of Elliott wave theory, the third wave is often the strongest and the longest, is because they missed the first wave and they're identifying that, hey, the first wave was a huge trend, there's a dip, and then the third wave happens because that's where most people will find out about it and start to enter after the first one has already happened. So make sure you stay away from these bad trades. Always try to trade with the trend when it's volatile, when there's volume present as well. These are going to minimize the chances of you perhaps losing money on a bad trade. You want to make sure you really focus on only the high probability trades. This will guarantee that the high probability trades that you take, it's going to increase to your longer term profit down the road. So the next thing we'll talk about briefly is what is a good trade setup to take. That really depends on the strategy that you're using. If you're a scalper, if you're a day trader, if you're a swing trader, if you're an investor. So myself, I'm always looking for scalps. So I'm looking for extreme volatility. I also hold positions for a few hours at a time, but I never hold a position overnight. Holding a position overnight is just not my thing. But if that's your thing and you prefer to swing trade because, hey, maybe life has come up and you don't have the luxury of time as much as other people. Maybe you've got a family, maybe you've got a full-time job, maybe you're in a new relationship, maybe your health is an issue as well. There's many factors that can prevent you from sitting on the computer like myself for 8 hours a day trying to find a trade. So a good trade setup, it really depends on the time frame that you're working with, depending on the trader that you are, and depending on the strategies as well. So, and to get into trading strategies, that's a really long and detailed subject. If you're really interested in learning more exactly about my strategies, check out my website below at daytradersclub.net. you can check out my masterclass trading course that I have, which is 29 hours long, over 54 lessons, and it goes over all of the strategies that you've seen me use, that I talk about on Twitter, that I post on YouTube. I describe them all in high detail. Maybe my exact strategies are not perfect for you, but at least you get exposure to someone else's strategy and you can take them and start to incorporate it into your own strategy and develop eventually your strategy over time. I don't think it's good to mimic somebody strategy for strategy. It's impossible to do that because everybody's got a different personality. Everyone has a different style. Everyone has different tolerances and skills as well. So it's good to look at other people's strategies, learn from them, and start to develop your own by incorporating into your own. It also comes with my lifetime Discord membership. In that group of mine, the Day Traders Club, we focus on finding trades together. I do a live stream 5 days a week. I answer any questions that you may have. 80% of my trades are posted before I answer them. But the main goal of the group is to build a community where we're all like-minded. We're looking for trades together. We're wanting to learn together in a very positive and encouraging environment. I think that the majority of people that have taken my masterclass course, and while being in the Discord group itself as well, they've probably upped their skill level to much, much higher than where they were at before. So I teach all of these trading setups of mine and hopefully can help you develop yours as well. If you're still newer to trading right now, you're probably trying a bunch of different things that might be working a little bit, that might not be working a little bit. And developing a strategy ultimately comes down to just trying a lot of different things at first and finding what works for you or what you like, and then tweaking it after it fails or succeeds. The majority of strategies that are developed, they're all learned from failures. I failed because I did this. What can I do differently to ensure the success of this trade? So an example would be when I used to short 5 Elliott wave counts at the top. It probably wasn't the best idea to only go with that. Then I started to incorporate things like bearishly diverging RSI, also MACD, and price action as well. And after you make so many mistakes shorting with one specific way, you start to add new things to it, or you change your strategy to ensure that there's a higher probability of success. So eventually, when you keep losing money in the market, I'm sorry to say, but you will eventually develop your own strategy after making so many mistakes. And that also comes down to documenting everything. You got to document your trades to know exactly what went wrong. If you don't document your trades, how are you going to learn from it? It's going to be impossible to learn from these mistakes if you don't document it. Documenting it is a way for you to physically see it on paper so you can review it. A lot of people say, hey, I made this mistake. I'm just going to remember it and I'm not going to repeat it again. It's really difficult to remember hundreds of trades and hundreds of mistakes. So learning through repetition, reading these mistakes every single day before you take a trade. Well, that's what I used to do. I would make a mistake in trading. I would write it down on paper. And before I take every single trade, I would read it to make sure that I don't make the same mistake. So one bad mistake that I used to make all the time was, for example, I used to trade when I was really tired. And I would force myself to trade. If there's a good setup and I see it, doesn't matter how tired I am, doesn't matter at what hour, I would make sure that I get into this trade, that I was greedy. And that ended up causing a lot of losses. So what I did was I wrote down on a piece of paper, I left it next to my bed or just with me at all times. Do not trade when you're tired. Cool down your Binance account. And that's what I do every single time now. Yesterday, I was up for 24 hours. I found another trade that I wanted to take, but I was already up to $11,000. So what I did instead of trading was I just ended up cooling down my Binance account. And I've never traded tired in a very long time. I don't make that mistake again of trading tired. When you're tired, you just can't make the best decisions. You're groggy, your reaction is slow, you're not thinking properly, you're not 100%. So that's just one small thing. The next thing that we'll talk about are entries. What are confluent reasons to enter a trade? Confluent reasons to enter a trade are multiple reasons why you should be entering a trade. If you're finding that there's 3 or 4 different reasons to enter a trade, it makes it really confluent to enter. Whereas if you are getting only 1 or 2 reasons to enter a trade, the probability of that trade being successful is probably not as high as 3 or 4 trades. The probability of you being successful with a trade that only has 2 confluent reasons versus a trade that has 4 confluent reasons, it's probably not as high. So finding multiple reasons to enter a trade makes the trade much more confluent. If there are confluent reasons to enter a trade, you're probably going to have a higher success rate. So if you have more reasons, it's like, okay, well, A, I want to enter because of this. B, I want to enter because of this. C, I want to enter because of this. Then D, E. So if you've got 5 reasons to enter a trade, well, it might be a much better setup than only one reason. So like the example that I gave you earlier for shorting the fifth wave, if you shorted it just because it was at the top of the fifth wave, well, that might only be one reason. But if you also notice bearishly diverging RSI, you're also noticing MACD that's about to cross over. You're also noticing price action that's showing resistance now and nasty candles. Well, those are four reasons to enter a short. Let's say you get another reason like it's breaking support trend line or even an EMA break as well. Now you've got up to six reasons. If you're finding so many reasons to enter a trade, the stars are aligning. And that should probably signal to you that it's a good trade to take. And whenever I find a trade with lots of confluent reasons to enter, I'm generally going to add size to the trade. More confluent reasons makes me more confident to enter the trade. If I'm more confident, I'm going to add size to the trade. If I only have one or two reasons why I want to enter a trade, it really does depend on how strong those reasons are. For example, an EMA break could be an extremely powerful reason to enter a trade if it has been trending for a long time above this EMA now and it finally broke to the downside. So maybe that one reason could be more powerful than others combined sometimes. It's just very, very circumstantial. But overall, you want to find trades with multiple reasons to enter. More confluent reasons to enter. I can guarantee that you're going to increase the probability of success for your future trades. And the last topic intertwined with the last one, which are high probability trades. I can guarantee that if you search for higher probability trades, you're going to probably profit more than just searching for these lower probability trades. You have to find tons of reasons why you want to make this trade. Find reasons towards the bias that it's leaning. If this coin is leaning more towards a long position because you've got this reason and that reason and multiple other reasons, then you've got a much higher probability of winning this particular trade, as long as, of course, your technical analysis skills are up there as well. And with a lot of experience and over time, I'm sure that your TA skills will be increased and it's going to allow you to hunt for these coins. I would highly advise to stay away from coins where you've only got perhaps one or two reasons to enter this trade. Why would you want to take this setup? Just because there's a small chance of you perhaps making a profit? Wouldn't you rather wait for a coin that gives you a very high percentage? It's really important to have standards. And I always tell the people in my Discord group when I find them forcing these trades of theirs and they're trading these coins that are not volatile, it doesn't have volume. I ask them, why are you taking these trades? The probability of you winning is just so low. And then they say, well, I want to make money today. And I tell them, you've got to have standards. No matter what you do in life, you've got to have standards. So for example, I used to take any trade that I can find because I was greedy. I didn't know any better. I would focus on anything moving a little bit, anything where I thought I could make profit from. I tried to be the jack of all traders, thinking I can capitalize on everything that I see. But over time, I started to specialize only in these specific setups that you constantly see me take all the time. And now when I'm taking the same type of setups, the probability of me winning trades is higher because I know exactly what to look for. So it's always really good to specialize in one specific strategy or a few. So I wanted to give you a really general idea of the best market conditions to trade. And I hope that this has really hit home. I hope that it has taught you something in regards to making better trades and knowing what to look for and knowing which coins not to trade. So thank you very much for joining me for part 7 of the best market conditions. There's one more episode after this for the final one, and this will complete the mini series. Thanks for joining me, everybody, and have yourselves a great day. Bye now.